Hi folks, Chuck Gibson from Financial Perspectives in San Ramon, California with September 2017's Charts on the Move. Another quarter's in the books and now it's time to move on to the final stretch of the year. Looking back over the last 3 months, I could not have predicted that the markets and stocks would be where they are currently. On several occasions, it felt like a correction of some sort was in the making, but it never came to be. As investors, it's easy to get sucked into using economic data and media talking heads to make justifications to buy or sell something. Rarely do they actually help with sound decision making, which is why removing them from your daily routine will help remove the urge to predict market movements. Since Labor Day, when the big money returned back to work, we've seen volume expand to average or slightly above and the reemergence of stock strength. It's encouraging to see that they've been buyers rather than sellers, because fragile and vulnerable markets tumble quickly. With the S&P 500 hanging around the psychologically significant 2,500 level for the past 3 weeks or so, this tells us that the foundation under our feet is pretty solid. Throughout the quarter, news headlines have been resoundingly bearish. The fact that we withstood wave after wave of bearish headlines means this market is far more resilient than most people realize. Those bears who tried to predict the market top and fight the trend have been crushed. In strongly upward trending markets like we're in, a market that refuses to go down will eventually go up. And up we went. In fact, that was the best September stock performance since 2013 as we closed out the quarter with outsized returns. As you can see in my first chart, all of the major indices were up more than 3.5%, with the NASDAQ once again leading the pack with a 5.8% return, followed by the Russell Small Caps at 5.3%, the Dow Industrials at 4.9%, the S&P 500 at almost 4%, while the NYSE brought up the rear at 3.8%. Now that's a good quarter. Looking under the hood at individual U.S. sectors, we can see in my next chart that technology was once again the big winner with a 4.4% return. This was followed by the past year's perennial loser, energy, coming in at 2.9%. Next up was materials with a 2.2% return. In spite of all the major indices closing higher, there were 4 sectors that actually printed quarterly losses. That list includes healthcare, utilities, consumer cyclicals, and consumer staples, which lost more than 5%. As you'd expect, the weakness seen in bonds during September was a direct result of investors reallocating money out of bonds and into stocks. In spite of September's weakness, the U.S. aggregate bond index ended the quarter slightly higher than it began. My next chart of the S&P 500 index continues to stair-step higher, perfectly illustrating an uptrend with higher highs and higher lows. Since this is a daily chart and it only goes back 1 year, it's not obvious, but September closed out at all-time highs. And speaking of all-time highs, my concern over the past 11 months regarding small-cap stocks lagging the overall market, well, it was put to rest as they rocketed from the bottom of their channel to lead the market higher in September. And like the S&P 500 stocks, an all-time high was printed on September's close. Keeping with the all-time high themes, in the first half of the quarter, the Dow Jones transport stocks were struggling in providing a Dow theory non-confirmation warning signal. But like the small caps, they found their mojo and closed September at an all-time high. Heck, it wasn't just U.S. stocks that showed up at the all-time high party. Many markets around the world were following suit. While I don't have enough time to go over them all, my next chart is that of the Vanguard World Stock ETF, which mirrors the FTSE Global All Cap Index, holding large, mid, and small capitalization stocks of companies around the globe. Another beautiful bullish chart riding this uptrend, making higher highs and higher lows along the way since the last correction in 2016. In July's video, I mentioned how XLE, the energy ETF, was building out a potential base and may provide an oversold counter-trend trade if it broke above this resistance. As you can see, a breakout never occurred, and instead it went on to make a lower low down here. While no divergence formed, you can see when I now update the chart to include September's action, that low turned out to be the bottom as it ripped 12% higher since. With hindsight being 2020, you can understand why I'm now regretting not taking the buy signal for client accounts. Viewing long-term, higher oil prices as a headwind, the opportunity will likely turn out to be just a short-term trade, which I try to avoid. Taking a quick look at gold, last month I noted this breakout on the daily chart, but was not willing to commit investment capital because of the large amount of overhead supply that lay above. In the longer term chart, you can see that supply here and how it has acted as resistance in the past. Updating the chart to show September's action, you can see what happened as price approached. It did just exactly what I was afraid of. It reversed. The longer term chart makes it easy to see that it's trapped in this long rectangular basing pattern. At some point, when it does break out, it's going to be a doozy and something we will want to own. But when? Well, assuming symmetry and the 2016 low as its midpoint, barring any major events, I would not expect a breakout and new bull market to commence until at least mid to late next year. I couldn't go a month without mentioning the US dollar. As expected, just when I threw in the towel and gave up, the dollar reversed course, found at least a temporary bottom, and rallied back through resistance. This may turn out to be just a long, overdue, oversold counter-trend rally, and eventually continues to the downside. But I have to point out this area here. As you can see, this was major support from back here, which did not hold as price moved lower. With the recent reversal, price is back above that level. It has triggered one of the more powerful signals in technical analysis, a false breakdown. If this turns out to be true, I would expect a very powerful dollar rally to occur over the next coming months and quarters. To add credibility to the possibility of a big rally in the dollar, I wanted to see how the big money is currently positioned. My next chart is the COT, or Commitment of Traders data, for the dollar. COT data is a report of how the largest money traders are positioned. You have to be the biggest of the big in order to be required to report your positions to the government and make it on this list. There are two groups of importance reflected in the data. The first group are the producers, known as the commercials, also known as the smart money. And the second are the large speculators or traders or investors. Most of the time, these two groups are on opposite sides of the trade. Since the smart money is called that for a reason, the data can be helpful to see how they're positioned. I found out the hard way, you don't want to find yourself on the opposite side of the boat of the smart money too often. In the upper pane is the dollar index, while the bottom pane is the positioning of the speculators in green, the smart money in red, and the blue line represents the small traders, which hold little useful information. The takeaway here is that in September, the smart money was now positioned long the US dollar for the first time since back here in 2013. I started out the year mentioning I expected we would see a lot more volatility than we had in prior years. I told everyone to buckle up as it would likely be very bumpy. That, at least so far, couldn't be more wrong. As you can see in my next chart in 2017, if the final quarter mirrors the first three, it will turn out to be the least volatile year on record. I probably shouldn't say this so that Ms. Market won't have the chance to prove me wrong again, but this is not normal, so don't get used to it. At the sake of repeating myself, barring any events, I do expect we see a rally into the year end. In fact, if the tax plan being proposed by our government can get written and passed, hey, stop laughing back there. You're disturbing my video. Well, it could turn out to be a real barn burner. My next chart is that of the stock market seasonality, which supports why I expect the last 3 months of the year to be constructive for stocks. And that's independent of any tax overhaul getting accomplished. When combined and looked at quarterly, you can see that October, November, and December have historically provided the greatest average returns of all 4 quarters. To wrap this up, my final chart illustrates how 2017 is closely mirroring the normal seasonal patterns. The black line is the S&P 500 average daily return throughout the year. Now this data covers from 1990 through 2016. The gray line is that exact same data as the black line, except it has the 2008-2009 market crash data removed. And finally, the red line is 2017 so far. Well, that's it for this month. So until next, as always, I appreciate your time and your attention, and I hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with September 2017's Charts on the Move.